Private lender IndusInd Bank and tech majors Infosys and TCS, as always, kick off the second quarter earnings season this week. So what's expected from corporate India this time around? Will earnings growth pick up pace after the subdued first quarter, or will the economic concerns continue to reflect in the quarter? Darshan is here to tell us what to expect. Morning, Darshan.
Good morning. So basically, it won't be good. First quarter was very bad, probably on a similar lines, and most of the brokerages for the Nifty 50 have indicated there could be a probable degrowth. So, but first, let's take a look at the trends that you could see, and you could see that the number of weakest earning was almost 50% in the last quarter, and the number of strongest earnings was the lowest, probably at least in the last since first quarter 2018. So, first quarter was really bad. Similar trends are expected as far as this earnings season is concerned. Obviously, the benefit of corporate tax by most of the brokerages, they don't believe will be part of the second quarter earning. They will be part of the third quarter earning. What are we anticipating? Let's take a look at sector wise what can be anticipated. This time around on the agri side, the monsoon has been good, but there has been a delay, and that may hurt the financials of the domestic companies, you know, like a Dhanuka Agritech, but some of the companies which like PI Industries or UPL, which cater to the export market, will fare much better this time around. So that's the agri side. Auto, we've all seen the numbers that have come in. There have been production cuts, there have been inventory corrections that have come in, and that is hurting the volumes of the company. Two-wheeler firms will be better because of the export markets that they have, but the four-wheeler, the commercial space, the auto anch space, all of them will continue to see pressure this time around. So that's the auto sector. Financials this time around, asset quality and exposure to stressed account will be the key. Even last time you saw that HDFC Bank also had exposure, which saw it come out with a weak set of numbers. Demand slowdown to hurt NBFCs and housing finance companies. Probably housing finance companies will be the worst in terms of faring this time around, given the exposure to real estate. The other sector that we want to speak about, that is capital good. Nothing much has happened. There was a slowdown in infra spending ahead of the election, and there has been absolutely no pickup in private capex. Some of the infra and road companies probably might do it, but the pure play capital goods might be seeing much more pressure this time around. The other sector is cement this time around. We will see decline in volumes this time around, but because of price hike, realizations will be better this time around. Decline in raw material prices because of petcoke, because of fuel cost, that is something that will aid margins of the company, but overall volumes are expected to be weak. The next one is basically the consumer space. Again, a lot of issues there. There are liquidity concerns. There were drought and floods. There was muted start to the festive season. Last time also, most of the FMCG companies came out with weak set of numbers. What will benefit is lower raw material cost. Oil has come off significantly, but ad spends has been higher and price cut is there. So overall, for FMCG, expect it to be a muted quarter. Last time around, paints was the only one that did well. It will be interesting to see their commentary this time around. Technology, margin expected to widen this time around. Revenue growth will be stable, but deal closures have been very, very weak this time around. So like last time around, IT will be muted. The next sector we want to talk about, apart from technology, is metal. Lower prices and weak demand for steel and non-ferrous. So this time around, metals will be weak. Some of the miners may see a volume uptick, but realization hasn't been that well. So that's metal. Couple of other stocks is oil and gas. OMC's refining margins may do well, but the inventory losses will be there. Reliance weakness in petchem business is seen, but the refining business probably might offset that, and we need to watch out how Jio is doing. Petronet expansion at Dahej will aid the company, and price hike will continue to aid margins for IGL, not so much for the other gas distribution companies. Some of the other companies, pharma, obviously competition and pricing pressure are there in the US market. Delayed approvals, the FDA issues, all of them will put a big dent as far as pharma companies is concerned. Domestic focused companies can do well. We've just released a report in terms of how the domestic sales have been there for the second quarter. That has been robust. Higher R&D cost and remediation cost will impact the margins of the company. And finally, the last sector we want to talk about, a few sectors, in fact, real estate. Inventory levels are high, lack of pricing power, balance sheet stress. So real estate, despite the stock prices going up, the financials are weak. And finally, in telecom, Jio's market share gain will continue this time around. And for incumbents, there will be muted top line growth this time around. Infratel probably won't be there because of modest tendency, but meaningful ARPU recovery is very unlikely for the telecom plays.